In October 2017, a fund listed on NYSE Arca with a promise that sounded like the end of an argument. No human emotion, no gut feeling, no panic selling at the bottom. Just a machine running on IBM Watson, reading news, filings, social posts, and financial statements across thousands of American companies and deciding what to buy. The world's first artificial intelligence exchange-traded fund, ticker AIEQ. It is still trading today, which means, unlike almost every claim made about AI and money, this one comes with a receipt. So let's look at it. Here is the comparison that matters, and I want to be careful about how it's made, because this is exactly where these arguments usually cheat. Both of these numbers come from the fund's own published performance tables. Same measurement date, the 30th of June this year. Same basis, both after fees. No cherry-picked window, no clever framing. On one side, AIEQ, the artificial intelligence. On the other, SPY, the first exchange-traded fund listed in America. It doesn't think. It doesn't read the news. It holds 504 companies and does absolutely nothing else. Over the last 12 months, the AI returned 17.5%. That's a good year, genuinely. If you told someone in 2017 their robot made 17.5%, they'd have taken it. The index fund that does nothing returned 22.15%. Over 3 years, the AI, 16.86% a year. The index fund, 20.46%. And over 5 years, this is where it stops being close. The artificial intelligence returned 4.48% a year. The index fund returned 13.26%. Roughly 3 times as much for doing nothing while thinking about nothing. And here's the part that should irritate you. The AI charges 0.75% a year. The index fund charges 0.0945, nearly 8 times the fee for a third of the return. I want to be fair to it because being fair makes the point harder to dodge. AIEQ has not been a disaster. It made money. In a lot of years, it made good money. It just never beat the thing that isn't trying. Not over 1 year, not over 3, and not over 5. Now, the obvious explanation is that this particular fund is just bad. One team, one model, one mediocre result. Except the research says otherwise, and the research is recent. At a conference this year, KDD, one of the serious venues for this kind of work, 4 researchers published a paper asking exactly our question. Can large language model investing strategies beat the market in the long run? Their starting observation is the one nobody selling you a course will mention. Almost every published result showing AI beating the market is tested on a narrow window of time and a small handful of stocks. And that, they write, overstates effectiveness through survivorship bias and data snooping. Think about what that means. Pick a few stocks that happen to have survived. Pick a stretch of years that happens to have suited your strategy. Anything looks like genius. So they built a testing framework, they call it FinSaber, and ran those same strategies properly. 2 decades of data, more than 100 symbols, and critically, they left the dead companies in, so the failures couldn't quietly disappear from the sample. The previously reported advantages deteriorated significantly, but it's how they failed that I keep coming back to. The AI strategies were too cautious in rising markets, sitting in cash, underperforming while everything went up, and too aggressive in falling markets, taking heavy losses right when it mattered most. Timid when it should have been brave, reckless when it should have been careful, exactly backwards in both directions. That is not a bug in one fund. That's what happens when a system pattern matches on the past and then meets a future that doesn't match. So AI can't beat the market, except that's wrong. And this is the part of the story I actually find remarkable. There is a fund that beat the market for decades. It's called Medallion, run by a firm called Renaissance Technologies, founded not by traders, but by mathematicians and code breakers. It is widely described as the most successful fund in the history of finance. Now, Renaissance is private. It publishes nothing. So everything I'm about to say is journalism, not disclosure, and I'll flag exactly where it comes from. According to one investor quoted by Institutional Investor, Medallion returned 76%. 76. In the year the world shut down. So the machines work. Case closed. Except you can't buy it. Medallion closed to outside investors decades ago. Today, it is essentially a private pool for Renaissance's own employees. Your money is not welcome. It doesn't matter how much you have. And here's the detail that turns this from an anecdote into the whole point of this video. Renaissance runs funds outsiders can buy. Same firm, same building, same researchers. In 2020, the same year, Medallion returned 76%. Two of those funds returned minus 19% and minus 31%. Read that again. Inside the building, up 76. Outside the building, down 31. In the same year, at the same company, run by the same people. That's a gap of about 95 points, and it depends entirely on which side of the door you're standing on. Now, the honest question, is that a scam? I don't think it is. And the real answer is more interesting. Medallion's edge lives in very short holding periods and very small inefficiencies, tiny mispricings that exist for moments. Those opportunities are finite. There is only so much money you can push through them. Push more, and your own buying starts moving the price you were trying to exploit. The edge eats itself, which means the strategies that actually work cannot absorb outside money. Not won't, can't. So they don't take it. And the funds they do sell you have to hunt slower, bigger, more crowded opportunities. A completely different and much harder game. One more thing, because I'd rather you heard it from me. Since Renaissance discloses nothing, those Medallion numbers rest on reporting. And at least one academic has publicly argued the returns stretch explanation to its limit. I'm telling you what has been reported. I'm not certifying it. Now, strip the artificial intelligence out entirely, because the underlying question is old, and the evidence on it is genuinely brutal. In Brazil, 3 researchers got hold of records from the CVM, the Brazilian equivalent of the SEC. Not a survey, not volunteers. Every single person who started day trading equity futures between 2013 and 2015. 19,646 people. They then narrowed it to the ones who really committed, who stuck with it beyond 300 trading days. 1,551 of them. 97% lost money. 17 people out of 1,551 earned more than the Brazilian minimum wage. 8 people earned more than a bank teller's starting salary. The single best trader in the entire study averaged $310 a day, with a standard deviation of 2,560, meaning even the winner was strapped to a roller coaster. And those numbers flatter them. They're after brokerage fees, but before income tax, before platform costs, and before the price of the courses. 2 findings from that paper matter more than the headline. The first, the longer people traded, the less likely they were to make money. Not more likely, less. Steadily as experience went up. The authors point out this is the pattern you see at a roulette wheel, where the more rounds you play, the worse you do. The second is the one I can't get past. They specifically tested whether persistent traders improve over time. 714,637 trader days of data. They found no evidence of learning, none. And the paper's opening line tells you exactly who it was written for. The results, they say, are contrary to what course providers claim. This isn't one study in one country. Taiwan, full market records across 15 years. Fewer than 3% of frequent day traders showed consistent profit. The United States, between 1991 and 1996, 66,465 households at a discount broker. Over that same period, the ones who traded the most earned 11.4% a year, while the market returned 17.9%. Trading more didn't help them. It cost them 6.5 points a year. And one last note from the Brazilian researchers, which I think is the quiet warning in all of this. They point out that back in the Taiwanese data, ordinary traders weren't yet competing against institutional high-frequency algorithms, which are, in their words, increasingly active in today's market. The game did not get easier. You just got better tools for playing it. So, can AI beat the stock market? Yes, demonstrably. The best trading operation ever built ran on mathematics and machines, and it made its owners staggeringly rich. And then it closed the door, because the thing that made it work would have broken if it let you in. The version they'll sell you, this buyable artificial intelligence fund, has returned about a third of what a fund that does nothing returned over 5 years, while charging nearly 8 times as much. And when researchers test AI strategies honestly, over decades instead of months, the magic evaporates. None of which means artificial intelligence is useless. It's extraordinary at execution, at risk monitoring, at reading more filings before breakfast than a person could read in a year. It just isn't a crystal ball. And the people who own the closest thing we've ever had to one decided a long time ago that you couldn't have it. Be honest with me in the comments. Would you hand your savings to an algorithm? Yes or no? And if the best one ever built refuses to take your money, what do you think that tells you? If you want the other half of this story, the boring fund that quietly ended up owning almost everything, that video is right here. Subscribe to Crest Royale for how money and power actually move underneath the story you're usually told.